Now it's time for Money Matters. Today we're talking about the basics of investing. Matt Dickens, CEO and founder of Strategic Wealth Designers, is joining us. Matt, you say there are really three things you need to consider no matter what level of investor you are. So what is your first tip?
So first, it may sound a little bit cliche, but pay yourself first. You know, a lot of individuals will try and spend everything through the month and then maybe save what's left over. You should do the exact opposite of that and try and pay yourself first, build it into the budget, set it aside, and then spend everything else. We really advise individuals to target 15% of your income should go into some sort of investment or retirement account. If you're nowhere near that right now, you don't have to go from 0 to 15. Just try and build up to it over time as you get pay raises, promotions, things like that.
You talk about something called the rule of 100 in investing.
This is really important, and this helps individuals understand the breakdown of risk versus safety regardless of your age. So basically what you do is you take whatever your age is currently, that's the percentage of your portfolio that should be safe and protected from risk. The difference between your age and the number 100, you could put at risk in the stock market, bonds, stocks, mutual funds, things like that. Only if you're comfortable with risk, doesn't mean that you have to. But if you want to be a moderate investor, try and follow the rule of 100.
You know, then we're all encouraged to get into a tax-deferred accounts, the 401ks, et cetera.
Right.
And but you say maybe you should also put some money in something where you're going ahead and paying the taxes.
Sure.
We don't know where the tax rates will go.
We don't know what they'll be in the future. You can
Right.
make a pretty strong argument that they'll probably be higher than what they are today when you take a look at the changing demographics that we have here in this country. So tax deferred is better than taxable, but tax-free is by far the best. So try and use things like Roth IRAs. Some employers have Roth 401ks. That's what we have with our staff at our company. You can use municipal bonds or sometimes certain insurance strategies, but try and grow as much money as you possibly can tax-free. So if taxes go higher in the future, in particular when you're retired, it won't have as much of an impact on you.
Well, should you try to move some over from a 401k, or would you say start
in some cases, if you're going to do something like that, you should definitely get an analysis done before you start doing that. But sometimes that does make sense because right now tax rates are arguably at historical lows. Chances are they're going to go higher in the future, so why not take advantage of this environment that we have right now?
All right, just some good information as always. Thank you very much, Matt. And learn more ways to make your money matter on WKYT.com. And if you have something you'd like us to discuss, send us an email to news@WKYT.com, and hopefully we can talk about it here.